Welcome back to Beyond Four Walls, Conversations on Affordable Housing. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. I'm joined today by one of the most respected leaders in housing finance and mortgage banking. Debra Still brings more than 4 decades of experience in the mortgage and housing industry, including a remarkable career at Pulte Mortgage and Pulte Financial Services, where she rose from branch manager to president and CEO. Most recently served as vice chair before retiring in January of 2026. Throughout her career, Deb has helped shape the future of mortgage lending, homeownership, and housing policy. She served as chair of the Mortgage Bankers Association in 2013 and remains deeply involved with the organization, having chaired numerous industry-leading committees and initiatives focused on affordable housing, diversity and inclusion, mortgage servicing, and GSE reform. For 12 years, she's also led MBA's Open Doors Foundation, which provides housing payment assistance to families caring for critically ill or injured children. Beyond her corporate leadership, Deb serves on NHC's Board of Governors and is the co-chair of our National Advisory Council. She's also a member of the National Association of Home Builders Mortgage Roundtable and serves on several nonprofit and corporate boards, including Chimera Investment Corporation and Enact Holdings. It's this combination of industry leadership, strategic vision, and dedication to advancing housing that makes her a fitting recipient of NHC's Housing Visionary Award, which she'll receive on June 24th at the Anthem in Washington, D.C. Welcome, Deb. I'm so excited to talk to you today.
Well, thank you, David, and thank you for having me. Very much looking forward to the Housing Gala and very honored to be recognized.
Well, it's kind of a no-brainer. Sometimes I think of you as the president of Been There, Done That. You have really been an inspiration to me pretty much since my first month in housing as a career. I mean, you were on the National Advisory Council of Fannie Mae when I started there in 1994. And, I remember listening to you in those meetings and thinking, wow, this is an education. This is a master class right from the get-go. And so I think one of the things I love to ask my guests is, just so we get a chance to know you a little bit, is what's the most interesting and important fact about you that has nothing to do with your work?
Yeah, well, I hope it's interesting, but some people may not know that I was an athlete growing up. I majored in physical education, health, and recreation in college. My aspiration was to be a PE teacher.
Interesting. And how did that go?
I taught for 1 year.
Uh-huh.
And then got married, moved to San Diego, could not get a teaching job in California, looked for gainful employment, and ended up in the mortgage business.
Well, their loss was our gain. It's been 4 decades in mortgage and housing industry. And what was it that drew you to the field where you said, yeah, this is something I think I want to do? And what's made you stay?
What drew me to the field was it was challenging, it was dynamic, it was ever-changing. For me, again, growing up thinking I was an athlete, I worked for a very small mortgage company. I got to learn all of the roles and all of the jobs. My first job was ordering appraisals, but I ended up discovering I had strengths I didn't know I had and just loved it. Loved underwriting, loved capital markets. I don't think there was a job I didn't enjoy. What made me stay is, of course, what most of us are committed to. It's really connecting the value of what we do in real estate finance to homeownership and what homeownership means to people, what it can do for folks, and the pride, the possibilities. It just became deeply meaningful to me. And then 7 years into my career, I found Pulte, worked very close to the point of sale, having been affiliated with a home builder, and where you really, really, it's not just loan files, it's folks at the point of sale with beautiful aspirations. And if we can help them do that, it just gave me a lot of pride.
So I love that. And your career path is would be considered really unusual today. You started there as your first job in the corporate world, and you stayed there throughout your entire career. What advice would you give to young professionals today, especially women entering the housing and mortgage industry? Because, I think there's a real bias these days to say, well, if you're anywhere for more than 3 years, you've been there too long.
Yeah, David, it's interesting. I think the data would suggest just the opposite. If you look at the data for CEOs, I think there's a strong bias toward a long term tenured commitment to a particular company. And of course, I got very lucky at Pulte, a great company that gave me a lot of bandwidth to grow. But advice to anyone looking to enter a leadership role in this great industry would be, first, be exceptional at the job that you're in. Don't always be focused on the next role. Of course, we all want to grow, but results matter and we need to measure ourselves by our results. Results are going to create the influence and the credibility to take the next step. I would suggest stay curious about how the business works. Raise your hand for every opportunity that others might pass by. Stretch yourself in the role you're in. Get involved in your organization in other ways than just your swim lane. I think it's particularly important, especially for women, to create visibility for yourself and truly get involved so that you stay visible in front of the leadership, whether that's committees or special assignments or business resource groups. There's so many different ways to volunteer beyond your current role. And then one of the things that I did, David, that I am so passionate about is really focusing on your leadership brand early in your career. There's always room for good leaders at every level of the organization, and really studying the qualities of leadership. It's a lifelong goal to become a good leader, but that can open incredible opportunities later on. And then I think be patient. It's a journey. I think when I first started working in the mortgage business, I was 23 years old. I wanted to be the bank president next year. It took 20 years to get in a CEO role, but there's so many interesting things to develop along the way.
I love that phrasing, leadership brand. How would you describe your leadership brand?
Oh, goodness. There's so many different aspects to leadership. I have always aspired to be an inclusive leader. I've always wanted to be an inspirational leader, really paint a vision for the future. I've obviously commitment to do the right thing. And in this business, over the last 40 years, there have been so many examples of folks that have chosen to run the business not in the best interest of the consumer or the core business fundamentals. I've always aspired to be a good communicator and transparent. So those are some of the things that I've worked on over the years. It's interesting. My leadership brand has always been about serving. I've always wanted to
Sure
serve,
has.
whether it was my company, my department, the broader industry as a whole. All of my leadership work has been focused on serving well.
I love that. And I think that also really sends a strong message to your team about how they're going to be successful because they see you do that. And that is really a virtuous cycle. It's contagious. The One of the things that I think we all struggle with is how we balance all the aspects of our career and our broader life, our family. It's hard, very hard for women. I don't want to in any way minimize that, but it is hard for everyone. I do think that women are held to a different standard. And you have this incredible family. You've been married for 50 years. That in and of itself these days is a big accomplishment. What's the secret to finding that balance? Because it does feel like a secret sometimes.
Certainly, I'm going to start with an incredibly supportive spouse who, for 30 years, Roger and I balanced two demanding careers. He in the Navy, me in mortgage banking. And of course, we had challenges along the way. I guess I always believed it was possible to be a wife, a mother, and an executive. And we approached our partnership with that mindset. Interestingly enough, we never competed over our ambition, our own personal individual ambition. Our focus was always the two girls and our
Mm-hmm.
family. We were very intentional about protecting family time, supporting each other, and truly staying clear on what mattered the most. I think if we had challenges, it was typically logistics. Who was
Yeah.
going to be where when? One of my rules was we would never be in the air at the same time. One of us would always have 2 feet
Mm.
on the ground
Mm-hmm.
as we both were traveling during certain parts of our careers. But, it certainly wasn't about doing everything perfectly, but really staying aligned on priorities and staying present. When I left work, and I worked hard and I worked long hours, but when I was home, I was home. And I did all the dance
Mm-hmm.
competitions and I did all the sporting events. For me, I was willing to live in two worlds fully, and God bless, it all worked out. But I will tell you, I can't imagine how I might have ever done this without the support of my husband, Roger.
I often tell our kids and younger couples we talk to that you never underestimate how difficult logistics are. But hard logistics and challenging logistics doesn't mean you have a challenging relationship. You have to really keep those separate. Logistics are hard. Although I will say that I probably learned more about what my kids were doing in a carpool line than I ever did when we were talking to them over dinner.
Yeah, Roger used to say, I can't believe these girls will have this conversation in the backseat of a car with me driving.
We are so invisible.
Yeah, exactly.
Let's talk about mortgage finance. And you've really had a front row seat to so much change in the mortgage industry. You started during the S&L crisis. We had 9/11. I think that given there was such a trauma to that nationally on so many levels, but in the finance system, setting aside the horrific cost that was paid by people in Wall Street, who died, the damage to the system and how we all had to navigate that damage to the system in the moment, I think is a part of the story that doesn't get told enough. And then obviously the 2008 housing crisis and COVID. You've been in leadership roles through all of those things. What are some of the lessons that from those experiences that I think are the most relevant for all of us today?
It's an interesting question, David, because, as I reflect on, as you just listed all of the different cycles that we've been through, probably the biggest lesson in reflection is we're always going to have cycles, and the cycles are always going to change. But if you think about the principles of leadership and the core fundamentals of the business, they don't change. And in uncertain times, they're more important than ever. And so I think, lessons learned. One, it's critically important to stay objective and disciplined. And it's also important to be able and willing to make decisions in very ambiguous times. I certainly learned leading an organization that clear communication matters to the team. People need confidence, they need direction, and they need to believe there's a path forward. And some of those cycles were very unclear. Certainly the great financial crisis. I thought I had seen it all in the Texas oil crisis. And during the great financial crisis, as the bubble burst in 2006 and the business was shrinking, and I'm
Hmm.
like, guys, we got this. We know what to do. Batten down the hatches, yada, yada, yada. And then the GSEs went into conservatorship. It's like, okay, we are in uncharted territory now.
Sure.
Really understanding what was going on and how we could navigate that was critically important. I've always believed, David, that companies get in trouble in good times, not in bad.
Hmm.
And so, certainly important through every cycle, sticking to the fundamentals of mortgage banking, staying operationally sound, driving out costs, and the resilience to think long term, even in good times, is critically important. I think also some of these cycles have created opportunities as well. But it is interesting to think, was there ever a normal time in my entire career, or it was just a series of cycles?
I think maybe it feels normal briefly in between. Thinking something is normal, I find, is really bad karma, and I find out that how wrong that was very quickly. When I think about the arc of housing in America, going back to 1931 when we were founded, and 1933 when the first housing bill ever was passed, other than the 37 Act, which really created the modern mortgage finance system, I can't think of anything that reshaped the mortgage industry so fundamentally as the Dodd-Frank Act. It really established a whole new set of rules and guidelines and speed bumps that has stood the test of time. I mean, I think that, one of the things that I loved when in the first Trump administration at Treasury, we were going through Dodd-Frank and saying how much of this was too much, et cetera. And there were people like you and Bill Emerson who were there saying in these meetings, especially at the side of the meeting, these three things are really problematic for us, but for God's sakes, don't change these five things because they really protect us from competing against the lowest common denominator of our industry. And I think so much of what was done then has stood the test of time. What do you think that Dodd-Frank got particularly right? And where is the industry still struggling with the regulatory regime that was established then? Because we have not had another great financial crisis like we did, but we've also seen housing prices go up and the cost of originating a mortgage go up. And what's going on there, in your view?
I was very fortunate. You mentioned my chairmanship of the MBA in 2013. And so on the ladder from 2010 onward, really had an opportunity to work close up with the CFPB as they were challenged to write the rules that the regulation required. And I honestly think they did a remarkable job of getting some of the big principles right. Coming out of the great financial crisis, the industry needed stronger guardrails. We needed clear accountability, and we certainly needed more meaningful transparency and protection for consumers. It pushed us back to better underwriting discipline with the ability to repay rule, which gave us a much healthier focus on sustainable housing. Quite frankly, it pushed us back to the core fundamentals that we should have never lost. And that was very helpful. The TRID rule, very complex, but I think the spirit of transparency for consumers, really understanding their costs, was a critically important principle. And so those two huge rules were very fundamentally healthy for the business. I think where we struggle still is the complexity of the regulations, the complexity of state regulations on top of federal regulations. Some of the rules are still very operationally burdensome. And the fear, I think we went through a period of time where we went through regulation by enforcement. And that was, unfortunately, I think, very impactful in not a healthy way to now the desire to innovate too early in any cycle. And so I think those are the things, I don't know, maybe a little more detail. I know lenders are still struggling with the yellow comp rule, which is definitely imperfect and should be looked at.
This
But
is how loan officers are compensated, and it means to ensure that they're not compensated for doing the wrong things, basically.
exactly. But I
That's
think
the
some of the
intent.
rules have had some unintended
Yep.
consequences that you could keep the spirit of that rule alive and fix some of the nuances that have created an environment that still isn't a level playing field for how you do business. Our challenge certainly is to balance the strong standards that have been put in place with a system that's workable, innovative, and accessible.
This issue around a regulatory approach that's dominated by enforcement and can often feel like a gotcha game. I really had tried when I was at Treasury to help people understand, and certainly since then, some of the work we've done on CRA, that lenders want to do the right thing. They want to know what the right thing is. And they need you to tell them this ambiguity or opacity does not mean they're going to end up doing more than you want. It means they're not going to know what you want. That does not serve either of us. And I think it's hard for regulators who've never worked in a company and understood how the people doing the stuff that we want in terms of the affordable housing space are competing for capital against folks who are doing something else. And we need that clarity to be able to compete inside our organizations. We're much more siloed than I think regulators understand sometimes.
Good lenders truly want to do the right thing, to your point, and they want that structure. It's really difficult to compete against those that choose to take shortcuts
Hmm.
and don't put the consumer at the center of their value system. And so, when I think about the great financial crisis, and for how many years did we compete against lenders that, of course, are no longer here? That's
Hmm.
hard. And so that structure is celebrated by anybody that wants to do this business the right way.
Yeah. I mean, the race to the bottom was the systemic failure. I remember talking to some lenders about 228s, and they said they're like lender crack. We know they're killing us, but we can't stop. Somebody was going to take your customers by offering mortgages you couldn't offer. And I think people just became a bunch of lemmings jumping off the cliff and following the wrong folks. And that's one of the strengths of Dodd-Frank.
I was told I was a dinosaur
Yeah.
because
Right.
we did not choose to offer some of those loan programs.
It's incredible. I was on the last countrywide contract call at Fannie Mae right before I left. And I remember thinking, wow, everything in this contract is like a cheat sheet on everything I've been told to never do during the previous 12 years of my career. And, looking back on it, it's no wonder that they ended up in conservatorship and that so many lenders ended up disappearing like countrywide. You spent your career in a special kind of mortgage company, which is an affiliated mortgage company with a home builder. What does that mean? Help us understand when you're with Pulte Mortgage. Does it mean you're only making mortgages for homes that Pulte builds? How is it broader? How do you interact with your parent company? Because I think people often don't understand that.
Yeah, we definitely look to build a vertically integrated business process with the home builder. It was all about the home buying experience, right from the point of sale where you're excited about buying the house to a joyful experience all the way to closing. And our founder always said that includes the mortgage too. So, right from the beginning, it was about the home buying experience, not doing transactions, if you
Hmm.
will. There's different models, and from time to time, we would experiment with what we would call incremental business. But in the long run, what we came to conclude is as an affiliated company, we only did business that was sold by Pulte Group. We did not try to do retail business long term. Part of it was capacity management. When the business was hot and Pulte needed us the most, was typically also at a time where maybe refinances were booming. And so we never had enough capacity when we needed it. And then the ability to scale and focus. Nobody ever wanted to be not the top priority. So the home builder, the parent company expected to be top priority. And if you have retail loan officers, you can't succeed without them being a top priority. So we ended up only doing Pulte business. And I think we were very conscientious. If you think about an affiliated business, our mortgage company did financing for 80% of the community. That was what our capture rate was. And so we had to think about sustainable underwriting guidelines. We wanted our communities to perform. We could not offer some of the products that would create damage in the community, the long term success of the community. So I think a lot of people, their perception is, oh, well, you guys have easier underwriting guidelines for your parent company, and not at all, just the opposite. We worked very hard to keep the fundamentals of sustainable housing and sustainable underwriting and an arm's length transaction from the seller. There's affiliated business regulations we have to follow. Customers need to be clear. when a customer chose, we called it the Smart Buyer Bonus Program, but a customer would elect to use Pulte Mortgage or choose to use their own lender. But every single customer always had choice on every transaction.
So you're competing against everyone else. But for the Pulte, I mean, if I'm buying a Pulte home and I'm going to be like, well, what about this company or that company? And so you got to make that case.
Absolutely. And we're competing anymore right till the closing table. One of the challenges of new construction lending is you might get a borrower approved within 30 days of application, and then it's 4 more months for the home to be built. And that's 4 months that this consumer has time to shop. And so we've got to stay competitive all the way to the closing table. We've got to show the value of the integration and the one-stop shop for a consumer to stay with us for 4 or 5 months.
So let's widen the lens a little bit because everybody's been focused on affordability. It's really a crisis honoring Congressman Cleaver and Congressman Flood. And they both have affordability crises. And I think it's reasonable to say if you've got an affordable housing crisis in Lincoln, Nebraska and Kansas City, Missouri, you got a national affordable housing crisis going on. This is not just about the coast. What, in your view, are some of the things we need to be thinking about, both in terms of the mortgage industry, but more broadly, on how we deal with this? Because it's just not sustainable.
David, it's interesting. As you mentioned, I just retired. I've been cleaning out an office that had 30 plus years of stuff in it.
Mm-hmm.
And I recently found the first article I was ever quoted in 20 years ago. And the title of it was Breaking Down the Barriers to Affordable Housing. So we've been working on this challenge for a long time. What do we need to do? I think certainly housing supply is a big driver of housing affordability. And so really looking at how to drive and how to build affordable housing. Some of that is regulatory, some of that is AI and innovation and robotic construction, R&D. There's a lot of things that will continue to go into challenging the affordability issue. And even if rates come down a little bit, you've still got all the costs of housing, which have gone up, whether it's insurance or maintenance or whatever. I think really using technology and innovation is going to be the key or the next step, if you will, to tackling the affordability issue.
So that's a great segue to artificial intelligence. And it seems like you really can't talk to anybody about anything without talking about AI these days. But it's the challenge of that, of course, is that the growth is exponential and the advances, I often say it makes Moore's law look quaint. And so 6 months from now, you could have a completely different conversation about AI in any industry. But thinking about where we are now and the snapshot of where things stand, what do you see as the real challenges and opportunities for AI in mortgage underwriting and risk assessment, and frankly, home building as well?
Certainly, from a standpoint of AI, as you say, is changing underwriting and risk assessment. Lenders have much more information and much more data to help them make decisions more quickly, more risk effectively, and more consistently than our manual process has given us. I think it's going to streamline document review. It's going to clarify fraud protection more fully. And whether it's home building or mortgage, cycle time, faster decisions, lower costs, and broader access is going to apply to both sides of the business. I think the challenge, a couple areas. One, it's a tool that we're all trying to understand in real time. It's going to create a real responsibility to make sure these models are transparent, well governed, carefully monitored. I think understanding the outcome of what the tools will give us is critically important. Being able to challenge the outcome and not just taking it face value,
Mm-hmm.
going to be sort of the art of the business leader, if you will. We all need to figure out how these tools work. We all need to evaluate the ROI of the tools and really understand and educate so that we understand not only the risks involved, but the opportunities. The governance is going to be enormous. I don't know,
Yeah.
that was long winded.
Yeah, no, not at all. I mean, there's so many facets to this, and the cost is so high. Tonight I'm going to a roundtable that J.P. Morgan Chase holds a couple times a year with Jamie Dimon, and the last time we were there, he said that they spent $2 billion on AI incorporation at J.P. Morgan Chase. By the time they finished that phase of the project, they had already saved $2 billion. And that's really great and inspirational. But at the same time, not many people have $2 billion to invest in AI. From the perspective of a CEO and a board vice chair, you're allocating a budget at AI in a company. What are going to be your highest priorities? Where do we need to look first? And how do we need to think about this longer run? I mean, you mentioned ROI. I think that's definitely the kind of foundation consideration. But what's that look like?
As I think about AI, which is just the new generation of technology that we've been
Hmm.
implementing for years and years and years, as a CEO or a board member, I would want to stay disciplined about where AI can add real value to the organization. In the past, it's a mix, right? But we've always protected the customer experience, thinking about building capabilities that either support our unique business model or our unique operating strategy or our customers' experience is a good place to start. But then keeping the customer touch points very high touch. So all the back shop administrative stuff that make our business process or operating model more effective. And I think AI with data and digital is really prime for that. I think the key is knowing the difference between where to use the AI and where to keep truly the
Hmm.
personal, high touch environment that makes one successful in a business that requires a lot of trusted advisors, a lot of coaching, and a lot of counseling. I would want a business case on every single application. I want to understand and hold accountable what we say AI is going to give us and what does it give us. And I think JP Morgan Chase, you're right, $2 million goes a long way, and not every company can have that. And that is really
Two
going
billion.
2 billion, sorry.
Yeah.
Yeah, that is going to be the differentiator between, but one would hope that it will be used wisely and governed well inside of that $2 billion. I think at the end of the day, AI that can make a company more productive or more cost efficient is key, not just more automated for the sake of being automated.
Although I guess for Elon Musk, $2 billion is a carrying error these days.
Well, yes, exactly. And, you think about the have and the have nots. David, it's
Hmm.
interesting. I recall your sharing some of the uses that you found for AI, and the data gathering is so powerful. I think of this as business operations, but those that do research and those that present data, this is mind boggling how powerful it could be.
Yeah. One of the most important things is what is the question you're asking and how are you asking it?
Yeah.
And I could have said that 20 years ago about bringing on a new employee. There's no difference. And so I'm not going to hire somebody and stick them in a cube and say, I'll see you in 6 months, tell me how it went. And there's a daily process and interaction. And I think that's one of the things we've learned with AI is treat it like an employee with limited experience, but a lot of knowledge. Make sure you're having that interactive conversation and don't assume that everything it says is right because no one is always right. But, I also want to leverage the fact that this particular employee might have a IQ of 4,000 and types 250 words a minute. That's useful. Never forgets anything I said. But yeah, it's going to be a real process and it's going to be exciting. But no one who ever lived through history said, wow, was that fun?
It's interesting. I just listened to a speaker last week on AI, and one of the points that he made that I thought was super interesting was AI will make, he was talking about the next generation, but
Mm-hmm.
AI will make some of the next generation much lazier and less smart.
Mm-hmm.
On the other hand, it will make others in the generation way smarter than they ever could have been. And
Mm-hmm.
it's all based on whether you let it do your thinking for you or you ask it probing questions that helps you learn and grow. And it was a really interesting concept to me. And I think you just mentioned ask the right question and learn, not become lazy and let it do your thinking for you.
It reminds me a lot, and we're of a certain age where we remember when calculators first were introduced into school math. And people were like, oh my God, people are going to never learn how to do math. And this is the end of math. People can just, you weren't allowed to use them in tests for years. And then I think somebody realized, wait a minute, why are we doing this? Because math isn't going away. And obviously, I think it's the understatement of the century to say that math has not been hurt by the calculator. But we always go through this kind of panic and worry when the status quo is being challenged.
Even with today's technology, when you think back, at least at the beginning of my career, what we used to do manually, whether it was calculating APRs or an origination fee,
Mm-hmm.
now we don't even think about. And we've come such a long
Yeah.
way. The point you made earlier, we haven't dropped the cost to originate, which is really interesting that we have yet to see a business case to the bottom line. I probably think we're trading one cost for another, headcount for technology, but it is amazing what we used to do quite effectively with a pen and ink.
I don't want to have this conversation without talking about what I know is one of the most important things that you've done in your career, which is the Open Doors Foundation at the Mortgage Bankers Association. It's so inspiring. I see you at MBA events, and I know when you're going to the podium by yourself, what's coming. It's the pitch, and it's very inspiring. This has been a real passion for you. Tell us a little bit about what the Open Doors Foundation is and does and what it's been like leading that.
Yeah, so the MBA Open Doors Foundation makes housing payments for families with critically ill or injured children facing enormous medical bills during a time of great emotional stress. Our mission is to provide hope and caring and, quite frankly, sustainable housing for families who, if they have a sick child, want a home to bring them home to. And so it's been just a beautiful mission. It's been 14 years of incredible generosity by the leaders of the real estate finance community who make contributions in a variety of ways throughout our fundraising efforts each year. David, one of the things you may not know is when I was asked to get involved with Open Stores, I was interested for three reasons. But the first one, again, coming out of the great financial crisis, was reputational repair. The residential financial services industry's reputation was in tatters, and Open Stores was a meaningful way for us to show that housing finance could also be a force for good in people's lives and a commitment to our communities. And so our first call to action was, okay, we've gotten through the financial crisis. Our reputation is in disrepair. Let's now get caught doing good. And that was sort of the rally cry 14 years ago. I hope you can tell the mission matters deeply to me. Housing stability is foundational. Our families are facing a medical crisis, and the fact that we can help them stay in their homes during a hardship that is far beyond any fault of their own is a beautiful thing. The other reason why I wanted to get involved is the foundation needed to be built with real operational discipline. Our charitable work needs to be run with the same operational excellence and accountability as any business. And I thought I could help there. So, a beautiful mission, deeply meaningful to me. We work so hard to help people attain homeownership or be in a rental home, and we can help them stay in that home when it matters most.
Yeah. I mean, I think that's so important. And it's tragic that when we think about foreclosures, some of the leading drivers of foreclosure are death or divorce and disease. We want to really be able to have that intervention because these people are really suffering. I want them to be able to pay attention to the things that really matter and not have to have a new crisis following the one they're already dealing with. And I know Open Doors does that, and it's been really inspiring hearing you talk about it. But in general, I mean, you've always been so inspiring to me. And I absolutely believe that the best part of my job is helping choose these visionaries. It often seems like obvious when we have the conversation. There's nothing more gratifying than telling people like, "Oh, who are you honoring this year?" And I said, "Well, Deb Still." And they're like, "Oh, yes, absolutely." I know you're embarrassed, probably rather not say that, but I can tell you, I hear it a lot and I really appreciate you and everything you've done.
Thank you, David. I appreciate that. And thank you for the kind words. It's funny when I think about visionary, that's such a compliment. I might not have ever given myself that label. I am always curious and I'm always willing to work for the goal and the outcome, but it is a great compliment and I appreciate it immensely.
Well, we were talking about math, but I think when you combine execution and curiosity on the other side of the equal sign ends up being visionary. Thank you so much for joining us. This is great. And I really feel like it's been a masterclass for people listening, especially if you're new in this business. I think you might want to be CEO someday. This is the one to listen to because your path has been really a pathway on how you move through this industry. And I love some of the advice you've given. It makes so much sense. So thank you. Thanks for joining us.
Thank you, David.
Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.
This podcast was edited by Resonate Recordings.